Welcome back to this session for CMA final students. This is your paper number 14, Strategic Financial Management. In this session, we are starting to revise the chapter titled as Investment Decision. Investment decision is also popularly known as capital budgeting. So you already know the basic concepts of capital budgeting. In this revision, I try to touch special points in capital budgeting or let's say advanced concepts in capital budgeting. But some of the deep points and some of the basic points where students usually commit a mistake. This is how we are going to revise this chapter. See, what is capital budgeting? As the name itself suggests, it is the long-term planning. It is the process of making a long-term budget to take a decision whether to invest money in a new project or whether to invest money for long-term or not. Whenever there is any capital budgeting proposal in front of you, there are several methods of evaluation. Some popular methods of evaluation or techniques of evaluation are shown in this chart. Look at this. Most of the techniques of evaluation are based on cash flows and not on profits. Okay. There is only one method which is based on profit, and that is accounting rate of return method. If I talk about methods, techniques which are based on cash flows, I can classify it into two parts, non-DCF and DCF. DCF stands for discounted cash flow, means the method where you do calculate present value of cash flow. So there is one non-DCF method which is named as the payback period method. Here you do not calculate present value of cash flows. And then there are four methods which are DCF methods where you do calculate present value of cash flows. One of those methods is discounted payback period method. And I can say it's a modified and better version of payback period method. Then the most popular method of evaluation is net present value method. Then, a method which requires some effort while making calculation, some labor while making calculation is internal rate of return method known as IRR. Then there is one method named as profitability index method or the PI method. So these are the various methods of evaluation in capital budgeting. You can see total 7 methods are there. And out of these 7 methods, 6 are based on cash flows. So the most important thing in a capital budgeting decision or in any investment decision is to properly calculate cash flows. Now, for this purpose, I can divide cash flows into 4 broad categories. Grouping cash flows make your life simple. You can proceed without grouping cash flows, but if you group cash flows like this, then your presentation of answer looks good, as well as to you also it is clear. Initial cash flow, these are the cash flows which happens at the time of start of the project, that is making investment in land, building, plant, machinery, furniture, fixture, vehicle, and working capital. In most of our questions, we do assume that initial cash flow will happen at a single point of time, and we call this point of time year zero. In this world, there is nothing like year zero. Year zero means the starting point of the project. So in most of our questions, we assume that this cash flow will happen at a single point of time, while practically for all big projects, it takes 1 to 4 years time to make capital expenditure itself. Anyways, for the sake of examination, initial cash flow occurs in one shot. So, as far as questions are concerned, this is a very simple step. Then the most complicated steps in examination is identifying, calculating annual cash flow, and we will explore it in detail. Annual cash flow means, you're making sales of your goods and making money. That's annual cash flow. Terminal. Terminal means at the end. What do you mean by terminal? Terminal actually means at the end. So when the project will come to an end, that is the useful life of the asset will come to an end, or when you decide to shut down your this particular business, then those cash flows are terminal cash flows, like sale of land, building, plant, machinery, sale of furniture, fixture, vehicle, realization of working capital, payment of taxes on capital gain, etc. And if a cash flow cannot be grouped in point number 1, 2, or 3, you can label it as other cash flow. So let's focus on calculation of annual cash flow. This table is a very simple table, but believe me, if you don't follow it properly, then you can commit mistakes in examination. So calculation of annual cash flows, method number 1, it's a proper method, it's a full method. Suppose you are selling 5,000 units at a selling price of rupees 100 each. So your sales is 5. Whether it is cash sale or credit sale, don't bother. Sale is like inflow. If it is cash sale, it's inflow today. And if it is credit sale, it's a future inflow. Today or tomorrow you will receive it. So today at least we are not receiving some of the sales because it will be realized in the next year. Hey, don't worry. That will be taken care. The debtors part will be taken care in change in working capital. So you don't bother about that here. So sales means cash in. For you, sales means cash in. Whatever debtors are there, you will take care of it. Then cash expenses. The cash expenses may be broken down into various parts like fixed expenses versus variable expenses, or raw material, wages, factory overhead, administrative overhead, selling overhead, distribution overhead, or individual titles like payment of salary, payment of factory rent, payment of advertising cost, etc. So in a question, they can give you in any name, you need to identify what are your cash expenses. So like raw material, it's a variable expense, 5,000 unit, 40 rupees per unit, 2 lakh. Labor, suppose it's a fixed cost, 1 lakh rupees, you deduct it. Sales minus cash expenses gives you cash profit. Cash income. See, again, this includes outstanding expenses. When I say cash, it means which is to be paid in cash either today or tomorrow or yesterday you have already paid. When I say non-cash, that means which is permanently non-cash, like depreciation. You'll never pay for it in future. So cash income minus cash expenses gives you cash profit. So far you have not deducted tax, and that's why you name it as cash flow before tax. If income tax figure is given to us, we can directly deduct from cash flow before. Cash profit is cash flow. So you take cash flow before tax and deduct income tax. 2 lakh minus 28,000. That will give you cash flow after tax. Why are we interested in after tax? See, tax is an outflow and we are interested in final net cash inflow. So tax should be deducted. If amount of tax is given ready-made, then we can directly do this. Cash flow before tax minus tax is equal to cash flow after tax. But they don't give us amount of tax. So we need to calculate tax. But for calculation of tax, depreciation, amortization, depletion, impairment, type of non-cash expenses are deductible. So you take cash profit, deduct depreciation as per Income Tax Act, not as per Companies Act, to arrive at taxable profit or the profit before tax. Then you deduct income tax. Take profit before tax, deduct income tax. Suppose at the rate of 20%, it is 28,000. Once your purpose of calculating tax is served and you got profit after tax, depreciation was a non-cash expense. You need to remove its effect. So you add back depreciation to arrive at cash flow. Right? This is the proper method. CFBT less depreciation is PBT. PBT less tax is PAT. Add back depreciation is CFAT. If tax is ready-made given, CFBT minus tax is CFAT. This is the proper method. Howsoever complex is the question, you can use this method. A shortcut method can look like this. See, instead of showing it in a vertical format, if I show this calculation in horizontal format, then this is how it will look like. Cash flow after tax is equal to sales minus cash expense, that is CFBT, minus depreciation is PBT. Now let me tell you, PBT into 1 minus tax rate is PAT. How? That's very simple. So PAT is equal to PBT minus the tax. So PAT is equal to PBT minus PBT multiplied by tax rate. This is how you calculate tax. Now you can take PBT common. So you'll be left with PBT multiplied by 1 minus the tax rate. This is how you can calculate PAT. So here you multiply it by 1 minus tax rate to get profit after tax. Profit after tax, add back depreciation is cash flow after tax. Perfect. Now this sales minus cash expense is actually CFBT. So I put here CFBT. All other things are same. Then I will open this bracket. If I open this bracket now, it will be CFBT into 1 minus tax rate minus depreciation into 1 minus tax rate. Then I'll open this bracket. If I open this bracket, it will be minus depreciation plus depreciation into tax rate. Once this happens, then look here. This minus depreciation thing and plus depreciation thing will be cancelled out. So the shortcut formula is you take cash flow before tax, make it after tax. You directly take cash flow before tax, ignore depreciation, right? And directly make it after. Then you say, oh, I forgot to take tax benefit on depreciation. Don't worry, I'll take it separately. So you do depreciation into tax rate, that's tax benefit on depreciation. Then you add it. Right? In the above example, your CFBT was 2 lakh, right? So you take 2 lakh multiplied by 1 minus tax rate, 20% is tax. So it's 80%. Plus depreciation, which is 60,000, typing error, multiplied by tax rate. 2 lakh after tax is 160. Tax benefit on depreciation is 12,000. Total is 1,72,000. Oh, same. Which one to use? Obviously, this one. This is shorter. But let me give you one warning. Don't use this method if the loss is to be carried forward to next year. If there is a loss in any year, in this case, PBT was positive, right? Positive. What if PBT is negative? There is loss. There are two ways. Number one, you assume I have other profitable business. Suppose this is, say, this is minus 1 lakh. There is a loss of 1 lakh, for example. Let's assume. Then you will say, I will deduct this loss from the profit of other business in the same year. And that way I'll have to pay lower tax in that other business. If I deduct this loss, the taxable profit over there will reduce and I'll have to pay lower taxes. That is called tax benefit or tax shield or inflow of tax. In that case, tax will become inflow and my loss after tax will reduce. This is setting off the loss in the same year from the profit of any other business, right? But what if this is my only business? It's a new company. In that case, I need to carry forward the loss. While in this method, there's an inbuilt, mostly the major reason for loss remains depreciation. Besides business loss, the major reason for loss remains depreciation. In this calculation, we are taking tax benefit on depreciation. It means we are assuming that if there is any loss, we will set it off here itself. Method 2 has inbuilt assumption to not to carry forward the loss, but to set it off in the same year. So don't use this method. If the loss is to be carried forward, then if the loss is to be carried forward, use first method. Now there is a third method of also. Third method is nothing but expansion of second method. This is your second method, right? In this method, if I replace CFBT by sales minus cash expenses, if I replace CFBT by sales minus cash expenses, and then I open this bracket. Then I open this bracket, it will become sales into 1 minus tax rate minus cash expenses into 1 minus tax rate. In fact, cash expenses can also be broken down. So don't deduct cash expense into 1 minus tax rate. You deduct raw material into 1 minus tax rate. Deduct labor into 1 minus tax rate. Deduct overhead into 1 minus tax rate, etc. So that's your final formula here. This was your final formula here. So you take sales 5 lakh into 0.8, 1 minus tax rate, minus raw material, deduct 2 lakh into 0.8, then deduct 1 lakh labor into 0.8, and separately add tax benefit on depreciation. Your after tax sales is 4 lakh, after tax raw material cost is 60, after tax labor cost is 80, tax benefit on depreciation is 12, 172, 1,72,000. Again, the same caution notice. Don't use this method if the loss is to be carried forward to next year. When method 2 is shorter, why to use method 3 at all? I will say, just a minute. This method is useful if sales or let's say inflows are not given. There are two machines, machine A, machine B. So these are two mutually exclusive. Whichever machine you choose, I hope you understand mutually exclusive. So it means these machines are competing with each other. You calculate net present value of all these machines and choose the machine which is the best one. So if you choose one, others are automatically rejected, right? So I was saying that there are two mutually exclusive machines. Whichever machine you choose, sales will remain same. So question said, okay, we are not giving you amount of sales. But yes, the material consumption will be different, the labor expenses will be different, depreciation will be different. So this is how it is given. They don't give you figure of sales. If they don't give you figure of sales and they say, sir, if sales is not given, NPV will be negative for both. Yeah, both proposals will have negative NPV. Choose the one which is less negative. Negative NPV simply means cost. It doesn't mean loss. It doesn't mean loss. It means cost. So choose the machine with lower cost, right? If they don't give you sales, you can't use method one because you need sales. If they don't give you sales, you can't use method two because to calculate CFBT, you need sales. Still, you can use method three. Why? Sales is not given. Okay, so then you forget about this step and start solving here. Minus cash expenses. That is, put a minus sign on cash expenses. Put a plus sign on depreciation tax benefit. Your answer may be negative. This is fantastic thing. In a difficult question, just keep in mind this spatial. This method is useful if sales is not given and outflows are given only. Don't use this method if loss is to be carried forward to next year. Then you'll have to devise some other method. Right? Okay. So let's use this one. Initial investment in a project is 1 lakh. Other cash flows are like, see, this question is not on calculation of cash flow. Cash flow calculation we have already seen. Now I'm talking about the payback period method. Okay, in this question, I'm talking about the payback period method. What is payback period method? Payback period is the length of time required to recover initial investment in a project. How do you calculate payback period? Okay, I'll tell you. How do you calculate payback period? So this is simply equal to initial investment divided by annual cash flow. So I invested initially 4 lakh rupees. And every year I have inflow of 80,000 fixed. So my payback period is 5 years, like this. This formula can be used only if cash flows are constant every year. What if cash flows keep on changing year by year? Oh, in that case, the situation will change. Like year 0, year 1, and then 2, and then 3. So at 0 year, sorry, you have outflow of 10 lakh rupees. In the first year itself, inflow is 6 lakh. In the, let's say this is 5 lakh. In the second year, it is 3 lakhs. In the third year, it is 4 lakhs. And in the fourth year, it is 10 lakhs. So I can simply calculate cumulative cash flow, right? So here this is 5, 5 plus 3, 8, 8 plus 4, 12, 12 plus 10, 22. I want to recover 10 lakh. So my payback period is more than 1 year. It is more than 2 years. I'll have to look at third year's cash flow also. There is a deficiency of 2 lakh rupees here. and I'm earning 4 lakh rupees in this year. So here my payback period is equal to 2 years plus. I want to recover 2 lakh more. I am earning 4 lakh more. So that is 2.5 years. 2.5 years. Right? For equal cash flow, you do it like this. For unequal cash flow, you do it like this. What are the disadvantages of payback period method? It does not consider time value of money, number one. And see, very interesting thing, it does not consider cash flow which occur after the payback period. If I change this 10 lakh to 50 lakhs, still the payback period will remain same. So this is the biggest disadvantage. It does not consider cash flow occurring after the payback period. Also, it does not consider time value of money. Right? Now, I'll tell you one more interesting thing. Look here. Initial investment in a project is 1 lakh. First year, your cash flow is 30,000. Second year, it is 40,000. Third year, it is 20,000. And then you realize salvage. Salvage value is 40,000. See, you realize salvage value obviously at the end of third year itself. You realize salvage value at the end of third year. So, sir, 20,000 is also at third year. Salvage value is also at third year. Why don't you add them together? No, 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 no. I can't add them together. Look at this form. Sorry. Look at this form. What did you do here? You said second year end, up to second year end, I recovered 8 lakh rupees. While I wanted to recover 10 lakh. So there is a shortfall of 2 lakh rupees. Now I look at my third year's earning and I say, in the third year, I am earning 4 lakh rupees. I just want to earn 2 lakh rupees for payback. So I make it proportionate that since it take 1 year to earn 4 lakh rupees, therefore it will take just half a year to earn 2 lakh rupees. So as far as your regular annual cash flows are concerned, you assume that within the year, cash flow doesn't occur at the end of the year. You assume that within the year, cash flow accrue evenly. So if 12 lakh is the inflow of in some year, you assume that every month you are earning 1 lakh rupees. If 24 lakh is inflow in any year, then under payback period method, you assume that each month you are earning 2 lakh. Now that's your regular sales and inflow. But that's not the nature of salvage value. Salvage value doesn't accrue evenly. It occurs at a single point of time, at the end of life of the project. That is why these cash flows can't be added together. This is an interesting lesson to be learned. Look here. So I make a table like this. Your 1, 2, 3 and then salvage value. 30,000, 40,000, 20,000 and then 40,000. Now I make a table of cumulative cash flow. So just look here. By the end of first year, I recovered 30. I want to recover 1 lakh. So this is insufficient. Okay. Now by the end of second year, I recovered 70. This one is also insufficient. By the end of third year, right, I recovered 90,000. This is also insufficient. If you ask me now, what is my total cumulative cash flow in 2.5 years? I'll say 70,000 this and 2.5 years and 10,000 here. So in 2.5 years, my inflow is 80,000 cumulative. So even by the end of third year, I have recovered 90,000 while I want to recover 1 lakh. So now I look at my salvage value. My annual inflows are insufficient to recover initial cost. So now I use salvage value, and keep in mind salvage value will not accrue evenly throughout the third year. It will occur at the end of the third year itself. 130. So to recover 1 lakh, I need 10,000 rupees from salvage value also. And if I'm using salvage value, my payback period is for sure 3 years. Full 3 years. Moral of the story, if you need to take salvage value to recover initial investment, payback period is equal to life of the project. Even if I calculate discounted payback period, you know, 30,000 is 27. So first I calculate present value of all these cash flow. This is 30,000 divided by 1.10 equal to 27273. Then 40,000 and then I press 2 times equal to 33,000. 20,000 and I press 3 times equal to, it is 15,000. And this 40,000 will also be discounted with 30 years factor, right? How to calculate discounted payback period? First you calculate present value and then you make cumulative total. 27 plus 33 is 60 plus 15 is 75 plus 30 is 1,05,000. So till the end of third year, my initial investment is not recovered. Then I need to use salvage value. So my discounted payback period is also 3 years. Interesting, isn't it? Okay. Treatment of special items in capital budgeting. Let's talk about allocated cost. So you already know what is allocated cost. If suppose you have taken a godown on rent and you are already using it in one of your businesses, and a part of godown is empty, it is not used. Now you have one proposal under consideration, one business proposal. If you start this business, then the empty space of the godown can be used for the new business. This empty godown space doesn't have any other use, doesn't have alternative use. It's, sitting idle. But for the sake of accounting, for the sake of cost accounting, you do allocate this cost. So my factory rent is 10 lakh rupees per annum. If two products are occupying, not factory rent, I'm sorry, the warehouse rent is 10 lakh rupees per annum. If the warehouse is to be occupied partially by existing proposal and partially by the proposed proposal, then I will allocate rent 50-50. For the sake of accounting, you do allocate. But even if you do not start the new project, this rent is otherwise paid. So don't look at the cash flows which are already there. Only consider those incremental cash flows which will be there if you start the proposal, if you accept the proposal. And that is why allocated cost should be ignored while taking capital budgeting decisions. Opportunity cost. See, if acceptance of a proposal results in avoidance of some cash inflow, then it is called opportunity loss. It should be treated as an outflow of cash for evaluation of the project, outflow of cash. And this one should be, allocated cost should be ignored. Opportunity cost is outflow of cash. Take an example. Suppose you already have one shop at a prime location in the city. It's a big shop. And currently you have rented it out. And your monthly rental income is 5 lakh rupees. So annually you are getting a rental income of 60 lakh rupees. Now you are planning to start a new business. If you start this new business, you will start using this shop yourself. You will, you will tell the tenant to vacate the place and you will start using it yourself. And as you are the owner of the shop, you need not to pay any rent. But definitely you are losing an opportunity. You could have rented it out and you will lose 60 lakh rupees per annum as your rent income if you start the new business. This should be treated as an outflow of cash. Then there is sunk cost. If you have already spent money on something and thereafter you are taking a decision, should I start the project or not? This is the sunk cost and it should be ignored. Say you are a pharmaceutical company and you have spent 100 crore rupees on research of a new drug molecule and you got a success also. Now, if you start production, that's fine. Even if you don't start the production, there is no alternative use of this research discovery. Now, whether you start production and selling the drug or you don't do anything, in either case, this amount is already spent. It cannot be recovered back in any other way. This is called sunk cost. And even if you reject the proposal, this cost is already occurred. Even if you accept the proposal, this cost is already occurred. So there is no difference whether you accept or reject the proposal. Hence, you should ignore this cash flow. Then common items. There are two mutually exclusive proposals. And suppose machine A versus machine B. Whichever machine you choose, it will be installed in a factory building. And the factory rent is 1 lakh rupees per month. So there are two choices. Either you can ignore it from both mutually exclusive proposals, or you can consider it in both mutually exclusive proposals. See, it's an actual outflow of cash. So it should be considered, it should be deducted. But what happens if you ignore it from both proposals? Because it's a common item in both. If you ignore it from both proposals, the NPV will actually rise. But their comparative position will remain exactly same as before. And therefore, the decision will actually remain same. So if there are common items in two mutually exclusive proposals, either you can consider it in both proposals or you can ignore it from both proposals. Your answer will definitely change, but decision will remain same. Now, one very important point, that is tax treatment of special items. A very simple rule of thumb is there. If any item is considered, its tax treatment should also be considered. And if any item is ignored, its tax treatment should also be ignored. Like you are ignoring allocated cost, so tax benefit on allocated cost should also be ignored. Like you are considering opportunity cost, so tax benefit on opportunity cost should also be considered. Sunk cost is ignored, so its tax benefit should also be ignored. Common item, if ignored, their tax benefit, their tax treatment should also be ignored. Common items, if considered, their tax treatment should also be considered. Item considered, tax treatment considered. Item ignored, tax treatment is also ignored. Simple, right? So now let's do one question which considers some of the special items. It says a large profit making company is considering the installation of a machine to process the waste produced by one of its existing manufacturing processes to be converted into marketable product. Okay, so proposal is buy a new machine for processing the waste. At present, the waste is removed by contractor for disposal on payment by the company of rupees 50 lakh per annum for the next 4 years. So, what was the moral of the special points? Do not consider cash flows just because they are to be considered for the sake of accounting, but consider only those cash flows which occur due to the acceptance of the proposal. If you accept the proposal, this cash flow will occur, otherwise it will not occur. Only those cash flows which are caused by the project, which are caused by acceptance of the proposal should be considered. So look here, if you accept this proposal, rather than removing the waste, rather than disposing the waste, you will start processing it. Currently, you are making payment for disposal of waste. You will save this money. So my dear friends, this 50 lakh rupees is actually inflow, right? First year, second year, third year, whatever is the life, for entire life of the project, 50 lakh rupees is the inflow. The contract can be terminated upon installation of the aforesaid machine on payment of compensation of rupees 30 lakhs. Oh my God. But this is the contract, na? And if you break the contract, you'll have to pay compensation of 30 lakhs before the processing operation starts. Life of this asset is 4 years. It is written at the bottom. So on one hand, there will be inflow of, avoidance of outflow is inflow. So there is the inflow of 50 lakh first year, second year, third year, fourth year due to this acceptance of proposal. But at the same time, there is outflow of 30 lakhs at year 0. This compensation is not allowed as deduction for tax purposes. See, my rule was if you consider the item, consider the tax. If you ignore the item, ignore the tax. Here you are considering this cash flow, so its tax should also be considered. But question denied that on this item, tax benefit is not available. Okay, so we will take 0 tax benefit. But you are considering this item as inflow, as income. So you must charge tax on it. I'm not saying charge tax on it separately, but if it becomes the part of your profit calculation, automatically a tax will be charged on it. So far, 50 lakhs inflow for 4 years, 30 lakhs the outflow at 0 year. The machine required for carrying out the processing will cost rupees 200 lakhs. Outflow of 200 lakhs at year 0 to be financed by a loan. By a loan. Question does not specify amount of loan. So let's assume that the loan amount is also 200 lakhs. Repayable in 4 equal installments commencing from the end of year 1. So let's assume that here it's not equal installments, it's equal principal. 4 equal principal. So 200 divided by 4 is like 50 lakh per annum you will repay. And on the outstanding balance, you will pay interest at the rate of 16% per annum. Now, these are financing cash flows. Try to recall that in capital budgeting, we consider only operating cash flows and investing cash flows. We don't usually consider financing cash flows. Should I consider these financing cash flows or not? So this is the answer to your question. There can be two point of views. Point of views. Number one, project point of view, and number two, equity point of view. In a project point of view, we simply try to calculate the cash flow which is available to the company as a whole. In equity point of view, we try to calculate the cash flow which is available to equity shareholders after making payment to other financiers. Cash flows which are available to equity shareholders before making payment to other after I'm sorry after making payment to other financiers. And project point of view means cash flows which are available to the company as a whole. So ultimately you need to focus on payment to other finance. See, equity shareholders are also kind of financiers now. But other than equity shareholder, you need to consider payment to other financiers like loan providers, debenture holders, etc. What are the cash flows to other financiers? Cash flows caused by other financiers. When you borrow money, it is inflow of cash. When you repay principal amount, it is outflow of cash. When you make payment of interest, it is outflow of cash. But if you are paying 100 rupees as interest and suppose 20% is the income tax rate, you pay 100 rupees and you get tax benefit of 20 rupees. So effectively, you are just paying 80 rupees. That is after tax interest cost. Interest cost multiplied by 1 minus tax rate. These are the cash flows. If you want to make evaluation of a project from equity point of view, then you should also consider this cash flows: inflow of the loan amount, outflow of repayment of loan, outflow of payment of interest, but after considering its tax benefit. But if you want to have a project point of view, then all these cash flows should be ignored because you don't want to look at from a particular financer. You just want to know what is the amount which is available to the company as a whole. See, in most of the questions, they don't give you these cash flows. They don't make available this information at all. What does it mean? By default, they want you to make evaluation from project point of view. By default, you have been doing this without knowing this. But if they make available these cash flows and then they don't say anything that what point of view to take, then better you take equity point of view, because if they have given these cash flows, there must be some intention behind it. So like in this question, they are talking about loan repayment. How much to borrow? 200 lakh. How to repay? 50 lakh in 4 years. What interest to pay? 16% per annum. It means there is an intention to treat these cash flows and solve the question with equity point of view. Okay. So 200 lakh will be inflow of loan at 0 year. 50 lakh will be outflow from year 1 to year 4. And whatever interest multiplied by 1 minus tax rate will also be an outflow. Now at the end of fourth year, the machine can be sold for 20 lakhs. That's terminal cash inflow. And cost of dismantling and removal will be 15 lakh. So the net salvage value is just 5 lakh rupees. Okay, now some other information. Sales and direct cost of product emerging from waste processing for 4 years. Sales rupees in lakhs. Every information is in lakhs. Fine, that's inflow. Material consumption is outflow. Wages is outflow. Other expenses are outflow. Factory overheads are outflow. Depreciation as per income tax rule is also an outflow. Right? So you need to make a deduction of this depreciation for taking tax benefit. Now, some interesting information, further information. Initial stock of material. See, stock of material means inventory. Inventory is part of working capital. Working capital is current assets minus current liability. Current asset means current asset includes inventory. In this question, they are not talking about debtors, cash and bank balance, creditors, outstanding expenses. They are just talking about inventory. So let's assume there is only one item in working capital and that is inventory. So this is information about working capital. I hope you know how to treat working capital in capital budgeting proposal. If not, let's quickly revise that somewhere here. Sorry. Treatment of working capital. So I'll say here that's 1, 2, 3, 4, 5 years time period. Let's take. And I say here year, then 0, 1, 2, 3, 4. To start the business, working capital needed is suppose 200 lakhs, imaginary numbers. And then you don't need, I'm sorry, then it remains as 200 lakhs. And at the end of fourth year, you shut down the business. So ultimately, the working capital level becomes 0. So now cash flows caused by working capital is like outflow of 200 and the level of working capital is maintained, so no other cash flow is needed. And then finally inflow of 200 lakhs. This is one scenario. Let's change this scenario and let's say here the working capital level rises to 300 and then it rises to 410, then it reduces to 100 and finally business comes to an end. So in this case, any increase in working capital will be outflow of cash and any decrease in working capital is inflow of cash. Decrease in working capital will be inflow of cash. This is how you treat working capital. And keep in mind, this working capital cash flow should never be put an item as before tax. Once you calculate profit after tax or cash flow after tax, thereafter you should treat this working capital cash flow. Okay, so let's get back to our business. So as I was saying, question mentions that initial stock of material required before commencement of the processing operation is rupees 20 lakh at the start of year 1. This is working capital at year 0, outflow of cash. The stock level of material to be maintained at the end of year 1, 2 and 3 will be 55. So 0 year stock is 20. First year it rises to 55. So that's an increase of 35 lakhs, right? 35 lakh will be outflow of cash at year 1. No cash flow at second and third year because the working capital level is maintained. Fourth year end, business will come to an end. Therefore, the working capital will drop to zero level. So 55 lakh drops to zero. It means inflow of 55. So 0 year 20 lakhs outflow. First year, second year, first year 35 lakhs outflow. Second year nothing. Third year nothing. Fourth year inflow of entire 55 lakh. Right. The storage of material will utilize space which would otherwise have been rented out for rupees 10 lakh per annum. Oh, opportunity loss. Outflow of cash for all 4 years. Labor costs include wages of 40 workers whose transfer to this process will reduce idle time payment of rupees 15 lakh in year 1 and 10 lakh in year 2. So out of this 75 lakh, 15 lakh is payable otherwise even if you don't accept the proposal. So additional cash flow is just 60 lakh. And out of this 75 lakh, 10 lakh is payable as idle time wages even if you reject the proposal. So just 65 lakh is wages. This will become 60 and this will become 65. Factory overhead include apportionment. We ignore allocation and apportionment of general factory overhead except to the extent of insurance charges of 30 lakh per annum on this venture. So entire factory overhead is just apportioned cost except insurance of 30 lakhs. So take 30, 30, 30 and 30 in 4 years. Income tax rate is 35%. That's fine. And you are required to give advice to the management. Look here. So sales figure I am taking as it is, which is given in the question. Material 30, 40, 85, 85. I am taking it as it is. But when it comes to wages, this 75 and 75 is replaced by 60 and 65. Other expenses as it is. Factory overhead, ignored whatever is given in the question and taken only 30 lakh of insurance cost. Loss of rent, an extra point. 10 lakh rupees per annum. Interest, 200 lakh into 16% is 32 lakhs. Then 150 lakh, because 50 lakh is repaid. 150 lakh into 16% is 24 lakh. 100 lakh into 16% is 16 lakh. 50 lakh into 16% is 8 lakhs. Depreciation, as it is given in the question, I have taken it as it is. So total cost is here. Sales minus total cost is my incremental profit minus income tax at the rate of 35% will give me profit after. Several other items to be considered. Still, this is like working capital. So, working capital outflow at 0 year 20 lakh, at first year 35 lakh, and at the last, this 55 lakh will be recovered entire. Cost of machine, outflow 200 lakh. Compensation to contractor, 30 lakh outflow. Amount saved on contractor payment is 50 lakhs. And tax on this at the rate of 35% is 17.5. So this is 50 into 0.65 basically. The net of these two is 32.5 lakh. Rather than considering these contractor payment and its tax here, we could have simply made a row over here, just like loss of rent. We could have added one more row, saving of contractor payment 50 lakhs. So automatically its tax benefit would have been considered. But this is also not incorrect. This is also a good way of treating it. after considering all these items, working capital, I'll just treat separately. For tax calculation, I won't involve it. Later, I will add it separately. Definitely. Now, incremental profit is your this profit. This is 70, 70, 110, and 94, right? This is the incremental profit. And then I need to add back depreciation. Tax on profit has already been calculated. So this is considered here as it is. Profit is taken from above table. Tax on profit is taken from above table. Depreciation is also taken from above table itself. These three items are taken from above table. Now, loan repayment. So initially there is the inflow of borrowing money, 200 lakhs. And then there is series of outflow of 50-50 lakhs. Profit on sale of machinery is 5 lakhs. Here we are assuming that it is written in the question, though it's not written, but let's assume that tax treatment on any capital gain or any capital loss is to be ignored because maybe we are following a block of assets theory, and even if this asset is sold, there are several other assets in this block, and therefore no capital gain or loss on sale of the machinery. So finally, adding together all above items, obviously those with the minus sign will be deducted. This is your incremental cash flow. Calculate present value of all these cash flows, right? At the rate of 15% per annum. So that's given in the question. I have not given it here in the question, but that's given in the question to discount cash flows at 15% per annum. Then you arrive at present value of cash flows, and finally the net present value is positive, which is 162 lakhs. As NPV is positive, the proposal should be accepted. My dear friends, this is equity NPV, right? Because you have considered loan related cash flows here and also here, and its tax benefit is automatically considered. You have considered all financing cash flows, and this NPV is equity. I can also calculate IRR. If I calculate IRR, these are the cash flows, right? Look here, 50, 37, 49, 53. I'm sorry, these are the cash flows: 50, 43, 66, 82, and 124.6. If you calculate IRR using these highlighted cash flows, the IRR is 111%. This is abnormally high. Usually you don't get such a high IRR, but it is the answer. I can't help it. So the equity IRR here is 111.46%. If you ask me to calculate project IRR, then first I need to remove the effect of financing cash flows which have been treated. Like if I reverse those cash flows, loan of 200 was added, so now I will deduct it. Repayment of 50 lakh has been deducted, so now I'll add it back. Interest figure, if I multiply it by 0.65, after tax interest figure I'll add. So then I arrive at project cash flows. Project cash flows means the cash flows if we ignore loan related cash. If we ignore loan related cash flows, then my outflow at 0 year would have been 250 lakhs. Inflow at first year would have been 113 lakhs, 131 lakh, 142 lakh, 179 lakhs. These inflows are without deducting interest, without taking tax benefit on interest, without deducting repayment. But at the same time, this outflow is without considering inflow of loan. These are project cash flows. Now, if you discount these cash flows at the weighted average cost of capital, you'll get project NPV. And if you calculate IRR using these cash flows, that's 39.29%. That will be project. So finally, moral of the story: If you consider all loan related cash flows, then cash flows are called equity cash flows. If you ignore all related cash flows, loan related cash flows, then the cash flows are called project cash flows. If you have equity cash flows and you discount it with cost of equity, you will get equity NPV. If you have project cash flows and you discount it with weighted average cost of capital, you get project NPV. And if you calculate IRR using equity cash flows, it will be equity IRR. And if you calculate IRR using project cash flows, that will be project. Simple thing. Ignore loan cash flows, these are project cash flows. Consider loan cash flows, these are equity cash flows. With project cash flows, you can calculate project NPV, project IRR. With equity cash flows, you can calculate equity NPV, equity IRR. As simple as that, right? So, see you in the next session. Till then, bye-bye.